Hi, um, welcome to the session on CMA Part 2, Corporate Finance. In the previous session, we were discussing about short-term finance, stated rate of interest, effective rate of interest, discounted loan, any fee charged while dispersing the loan, and when upfront interest and fees are deducted, how to calculate the effective interest rate. These are the points we discussed in the previous session with some calculations. In today's session, we'll discuss further some more notes on short-term finance. Begin with the compensating balance. Compensating balance is nothing but an amount which is an amount of loan granted by a financial institution, which is a portion of which is held by bank with no or nominal interest. A bank may pay you interest or may not pay you, even if bank pays you interest on the compensating balance, which is very nominal, not the interest what is charged on the loan amount. Let's see an example here. Suppose a bank disbursed a loan of 100,000, and the bank policy is to maintain a compensating balance of 20,000. So out of a loan amount of 100,000, bank holds 20,000 and disburses only 80,000. So the business here receives only 80,000, not 100,000, because this 20,000 is still held with the bank. Whereas the bank charges interest on 100,000. Effectively, the business uses only 80,000 in the business, but pays interest on 100,000. So the cost of the loan is higher than what you assume to be. Yeah, say a bank is charging 8% interest on 100,000, but a business is using only 80,000. 8% of 100,000 is 8,000 per annum. This 8,000 is the amount paid on 80,000 used in the business. So when a stated rate of interest is 8%, the interest is expressed in terms of the total amount used in the business. 80,000 times 100 will give you 10%. See, your cost increased from 8% to 10%. Because this amount, $20,000, which is a part of loan amount, is held with bank. And after 1 year, you just hand over $80,000 to a bank. This 20,000 will be added by bank to clear off your loan of 100,000. So this amount is a compensatory balance or compensating balance, held as a minimum balance to be maintained from this loan amount. Of course, this will be adjusted at the time of closing the loan amount. But interest is charged on the total loan amount. Therefore, the cost will increase from 8% to 10%. Here, 8% is called as stated rate of interest, and 10% is called as effective rate of interest. So you need to use these funds in the business, keeping in view that the cost of the loan is 10%. Cost of the loan is 10%. So your earnings should be greater than 10%. Don't compare 8% as a threshold. You should earn, keeping in view of the cost of the loans as 10%. So here, a compensating balance is maintained of $500, and the loan amount is say 10,000 at the rate of 10%. Effectively, the loan amount is 10%. Loan amount is 10,000, and the stated rate of interest is 10%. Effectively, the cost is only 1,000. Cost of the loan is only 1,000, but this loan amount among 10,500 is held by bank. Therefore, the interest will increase from 10% to 10.53%. And suppose the compensating balance with discounted loan are the terms of the financial institution. So what I mean is 10,000 is a loan amount. Anyway, 500 is a compensatory balance that is deducted. So the net amount received is going to be 9,500. This 10,000 is granted at 10% interest, which is 1,000. Even 1,000 is also deducted upfront. So what you receive is 8,500. So the cost of loan will still increase. The effective rate interest annualized percentage rate will increase. Earlier it was, see, stated rate was 10%. When this compensating balance was considered, it was 10.53%. Now, even interest is deducted upfront, which is called discounted loan. The interest increased to 11.76%. You in the finance department or treasury department consider this rate of interest based on the banking policy and consider this rate of interest used while using the funds. Now let us discuss about the cost of giving discount or cost of not taking discount, because in the previous calculations we discussed about the cost of short-term finance. What is my cost of short-term finance in the previous calculation? 11.73. So now the question is whether I should borrow from a financial institution at this rate, because I am in the need of money, I need a short-term finance, else I give a relaxation to my customer accounts receivable, saying that your invoice amount is say 10,000. If you pay this 10,000, now I'll give you say 2% discount. Now whether we should tell your customer to pay us this amount at 2% discount, or we should borrow from bank, let him pay without any discount on a net date. So we did all the calculations, what is the cost of the loan in different situations. Now let us work on this cost of giving discount to our customers. When cost of giving discount to customers is cheaper than the borrowing rate, better you give discount to your customer. But when it's costlier than short-term loan, tell your customer to pay on the due date. Now let me tell you here, in the previous calculation, the rate of interest when we borrow the loan of 10,000 from a financial institution, which is discounted loan and having a compensatory balance, was 11.73. Now say for example, a customer owes us 10,000 and we have a credit terms saying 2 of 10 net 60. What does it mean? A 2% discount will be given if the invoice is cleared within 10 days time. Else the customer can pay full amount any day between 11th day and 60th day. A 2% discount will be given if the invoice is cleared within 10 days from the date of invoice. Else customer has to pay full amount of invoice from any day between 11th and 60th day. So here discount rate is 2%. 2% is the discount rate, and this 10 I used here is discount period, means 10 days time from the date of sale, and the net period here is 60 days. So you can pay me in 60 days without any discount benefit. So if he pays this amount within the discount period, he will pay only $98 for every $100. But if he pays any amount between 11th day and 60th day, he will pay me $100. Now, based on this, we need to calculate what is the cost of giving discount, whether we should borrow from a financial institution or we should give him. For this, what we need to do is we need to find out one formula to calculate the cost of giving the discount, which is discount rate divided by 100 minus discount rate times 365. 365 is the total number of days, or you can take even 360 as per the question given. If the question is silent, take 365 days divided by net period NP minus discount period DP. Then overall you can get percentage by multiplying 100. So here discount rate 2 divided by 100 minus 2 multiplied by 365 days in a year divided by net period 60 minus discount period 10 times 100, which will give you 2 divided by 98. 2 divided by 98 times 365 divided by 50 will give you 14.89%. So if we give discount to our customers, telling him to pay within 10 days of the invoice, the cost of giving discount is 14.89%. Whereas if you borrow money from financial institution for the same period, it is going to be 11.73%. So when we compare here the cost of borrowing and cost of giving discount, we feel that cost of borrowing is profitable than cost of giving discount. So we prefer to borrow rather than giving discount to our customer. So we need to calculate both the cost of the loan as well as cost of giving discount. Whichever is lower, you need to accept. We understand that the cost of giving discount is better. Cost of borrowing is better than giving a discount. So we use the formula here, 2% discount if the invoice is cleared within 10 days, else the customer can pay full amount in 60 days. So the cost of discount, what we lost by offering this terms, let's see here, 6% interest, which is $15, but your customer is paying, in 90 days, it should be 60 days, then it will give you the different amount. And if you have a loan fee, you have 5% or $5. $5 should also be considered. This is annualized rate of interest, and discounted loan will be for $100 with a 2.2%. It is 98. 98 you are getting in 10 days time. Now dr divided by 100 minus dr divided by 360 or multiplied by 365 divided by NP minus DP will give you 14.9%. If the company, your customer company pays within 10 days. So 14.9% is compared with the bank interest rate of 8%. So cost of giving is much higher than cost of borrowing. So better to borrow instead of giving discount to customer. Let him pay in 60 days time. Commercial paper. Commercial paper is a promissory note issued to raise a loan for short period. Commercial loan is issued by corporates to other corporates or to individuals. Company A is issuing commercial paper. Say each commercial paper value is say $100,000. So these promissory notes are issued to other individuals and corporates for short period at the rate of, say, for example, 8%. 8%. So the individuals who buy these commercial papers from company A will get interest at the rate of 8%. Okay, it's a short-term borrowing. It's a short-term borrowing. The commercial paper borrowing period is from 30 days to 270 days. So within 270 days, company A will have to repay this amount by taking the commercial paper back. So these other corporates and individuals will get interest of 8% per annum on 100,000. It is nothing but an IOU type. Okay, IOU, or we can say it's nothing but like a promissory note for a short-term borrowing. Now, say commercial loan is issued at a discounted basis. Discounted basis means the amount of interest is deducted upfront, like this. Okay, what you need to do is, say for example, you need to find out the discount amount, you need to see the face value amount, you need to find out the number of days the amount or the commercial paper is issued, and calculate annual rate of interest, effective annual rate of interest. So the calculation of effective rate of interest on a commercial paper include, you need to find out first of all the discount amount, how many days the duration of the commercial paper, then calculate the net amount received, that's the face value of commercial paper, and what is the value of the discount given. Then you can calculate effective rate of interest. Let's see here with one example. 1 million commercial paper was issued for a period of 90 days at a discounted rate of 4%. 4%. Remember here, 1 million is the value of commercial paper issued for 90 days, and the discount rate is 4%. What does it mean? 1 million face value instrument, 1 million face value instrument was issued for 90 days. 1 million times 4% of 1 million equals to 40,000. But this is issued for 90 days, 1 quarter. So 90 divided by 360 will give us what? 10,000. So a value of 1 million worth of a commercial paper was issued for 990,000. What does it mean? Say on January 1st. On January 1st, company A issues a commercial paper to company B for a short-term borrowing to be repaid to company B 1 million. But at the moment, company A is receiving only 990,000. The commercial paper face value is 1 million, but issued at 990,000. So company B will pay only 990,000 to get this instrument of 1 million. So after 90 days from now, January 1st, say March 30th, 90 days, company B will get 1 million from company A. So what is the cost of company A on the commercial paper here? That is 10,000. 10,000 for 90 days. Now you need to calculate annualized interest rate. Company B is paying only 990,000, but getting in a commercial paper worth 1 million. And after 90 days from that date, okay, when you present the commercial paper back, you will get 1 million. So $10,000 is a profit to the company, the B, company B. But for A, what is the annualized cost? Let us see here. So the cost of this commercial paper is 10,000 at the rate of 4% for 90 days. Step 2, calculate the total amount received, 990,000. Upfront, this interest is deducted because it is a discounted one. Now calculate effective rate of interest, 10,000 divided by 990,000. So the rate of interest cost of the loan is 4.0%, 4.04%. Now let us discuss about accounts receivable collateral. What does it mean? When we sell the goods on credit, say for example 90 days credit, 60 days credit, 120 days credit, we pile up with the receivables. You'll have lots of accounts receivable. When you are in need of money, your company needs money. You cannot ask your customers to pay you because they hold a credit period of 90 days. You sold just yesterday, say for example. Say this customer owes you 200,000. You just purchased these goods with 90 days credit yesterday. So you'll have to wait 90 days to get this money. Is there any way to get this money faster? So what we discussed in the previous session, we will give him payment terms like DR, discount rate, if cleared within 15 days, if cleared within 10 days, else you can pay me the full amount in 90 days. Okay, so here if the customer doesn't pay you within 15 days, that's not mandatory that the customer has to pay within 15 days. It is up to him. If he wants to avail a discount of 2%, he will come and clear this 200,000 bill with a 2% discount. So what happens if he doesn't have enough money? He will wait until 90th day. He will sell the goods for cash, collects, then he comes back 90th day and pays full amount. So what happens if you are in the need of money before these days? So we can give this as collateral, a security to a financial institution to borrow money. So what we do is we sell goods to our customer and we sell these receivables to a bank. We sell goods to a customer, but we sell receivables to a bank. Bank for how many days? 90 days. Because bank knows that this is going to be collected in 90 days. So bank's finance it's for 90 days. But what is the guarantee that the customer will pay you in 90 days? So this is the reason why the financial institutions scrutinize your customers, scrutinize whether they're worth or not. So now our company is pledging this receivables to a financial institution lender, that if any delay or default in my customers, I will be held responsible for that. So this is your company, your customer is B, you sold worth $200,000 here, goods for 90 days credit. So this receivable is sold to ABC Bank. ABC Bank. So ABC Bank will ask you that what is the guarantee that your customer will pay in 90 days. So company A will take responsibility. If B doesn't pay this amount, A will be held responsible for paying this amount. And this is the reason why the financial institutions take the collateral of the receivables and only loans up to 70 to 75%, 80% like that. So in the 200,000, your company will get a loan of around 75% or when you are getting 75%, 150,000, the interest is charged on 150,000. When the banks collect this amount from your customer 200,000, the remaining 50,000 will be given to you. When the bank is not able to collect from your customer, bank will collect back this 150,000 and hand over any document which you gave to bank. So it is purely subject to the risk of the default of your customer. If your customer pays full amount, the remaining amount will be credited to your account. Sometimes our firms may sell these receivables outright. Means what? Whether the customer collects or whether you collect from my customer or not, it is up to you. So risk is transferred to you. That like 200,000 worth of receivables are sold for say 140,000. So there is a loss of 60,000 to the selling company. So the buying company will have to collect from the customer by hook or crook. If not, the company B, which is buying these receivables, will be in risk. This is outright. It means without any recourse. Without any recourse means company B cannot come back to company A saying that your customer is not paying me. You'll have to pay me back this 140,000. No. The receivables were sold without recourse. With recourse means we will pay interest for this period, and if customer doesn't pay, then we'll pay back this 140,000 to B, the lender. Now let's take an example here. Say for example, our company average monthly sale is 100,000. So yearly it is going to be 1.2 million. Okay, and we are giving say 60 days credit. 60 days credit means always you will have 200,000 in receivables. 100,000 per month, 60 days, 2 months. So accounts receivable balance on any day will be $200,000. And say for example, we approached a bank that always we have 200,000 balance of accounts receivable on our balance sheet. We want some finance on this balance. So we'll give this accounts receivable as collateral, means security. Say bank agreed, but to finance to the extent of 70% of receivables. So 70% of receivables, the amount what you're going to get is 140,000. On 140,000, say bank is charging you 11% interest. 11% interest. 11% of 140,000 is 15,400. So your cost of borrowing is 15,400 on this amount. Not only this, there is a fee of 1% on the total amount collected, total amount of receivables. Total amount is 100,000 here. So 100,000 per month. So 100,000 times 12, that is 1.2 million. 1.2 million times 1% is 12,000. So how much you are getting here? 200,000 times 70%, 140,000. On 140,000, you are paying a cost of 15,400 towards interest, 12,000 towards fee. So always remember this fee is collected on the total receivables, whereas the interest is calculated only on the loan amount. Now 27,400 is the total interest and fee on the amount received, on the loan amount received, 140,000. This is annualized amount. Therefore, 1 divided by 1 is nothing but 12 months divided by 12 months. You can ignore this. 12 divided by 12. So your cost of this accounts receivable finance is 19.57%. Always remember two things. One, The interest is calculated on the loan amount granted, which is some percent of the total receivable balance, whereas the fee is collected always on the total receivables for 1 year. It's a monthly sale, therefore I multiplied with 12, that is 1.2 million times 1% is 12,000. Always remember, fee is calculated on total receivables, whereas interest is calculated on the loan amount granted. Now let us discuss about the amount to be borrowed when a bank offers loan with a compensatory balance. Amount to be borrowed with a compensating balance. In a sense, the financial institution is deducting some amount towards compensating balance, which should be maintained with the bank, and only net proceeds are dispersed. So here 150,000 is a loan amount required. 150,000 is a loan amount required. Financial institution is maintaining the compensatory balance of 15%. What does it mean? If I borrow $100 of loan, compensatory balance, which is held by the bank, $15, and I'll be receiving only $85. Here my requirement is 150,000. If my requirement in my hand is 150,000, I cannot borrow 150,000 because 150,000, 15% will be held with the bank. I'll be getting only 115,000, or sorry, 22,500. Then I'll be receiving less than 150,000. But net amount in my hand should be 150,000. So I must borrow more than 150,000. What amount is to be borrowed? For this, the formula is the amount to be borrowed equals to amount needed, what amount is required, amount needed to be borrowed, divided by 100 minus percentage compensatory balance. You can use this formula to find out the amount to be borrowed. The amount needed here, the firm needs 150,000. 150,000 times divided by 100 minus compensatory balance. Compensatory balance is 15%. So 150,000 divided by 85 will give you 176,470.5 or something like that. So it is C here. So if you borrow 176,471, in your hand you will get 150,000. Let me clarify this. Say loan amount is 176,471, but the bank is holding 15% of the loan amount as compensatory balance. So 15% of 176,000 is 176,471. 15% is 26,471. 26,471. This amount is held by the bank. Okay, the net amount which we take home is 150,000. So when you need 150,000, do not borrow 150,000. You should consider compensatory balance as well and apply this formula to know what amount to be borrowed. This is the end of the session on corporate finance. We discussed about different forms of loans. We calculated effective rate of interest, compensatory balance, discounted loans, accounts receivable financing, invoice factoring, and the amount to be borrowed in case of compensatory balance. This is the end of the session. on corporate finance. Have a nice time.